It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. Welcome. Podcast time. Johnny Dean, host. Not an advisor, but I'm here with this guy who isn't actually your living, breathing advisor, Professor Rick Plum.
I have been now. I'm starting into my 5th decade of doing this. Not 50 years of doing it, but 5 different decades.
Yeah, what? So 80s, 90s, thousands, teens, and now the 20s. Yeah, you're right. This is 5 decades of doing it. There's some experience behind you right there. That's not
it's kind of, when I thought of it the other day, I thought, man, I'm getting old.
Well, you are getting old, and you've been a certified financial planner professional now for how long? I mean, when did you get that CFP? It had to have been 30 years ago.
It was like 1990, either 90 or 91. I can't remember exactly.
Right. So we're coming up on 30 years of that. We're coming up on 30 years of me doing this show in one form or another. That'll be this summer. Do you realize it was the first Gulf War when I started doing, when I started participating in this particular, it was a radio show back then where we were actually on the radio. It's been 30, that's a long time, man. We were young bucks. Now look at us. I'll tell you. But anyway, it's nice to have you back. I know some people listen to these podcasts one after the other, so no time has passed, but for you and me, it's been a couple of weeks since we've been in the studio here.
Yes.
So it's nice to have you back. You had a little excursion across the country, I guess. How'd that go?
It was very nice. We got slowed down by some snow going through Texas. I'm coming down pretty hard for a while, but
yeah.
It's if you've never driven cross country, I would say take longer than the 3 days I did it in. But there's some beautiful, beautiful country out there.
Oh, there really is. Now, if you come from where we do, which is the lower left corner of the U.S. and in California, we don't see much weather. We don't see much else other than palm trees, sunshine, and some asphalt. But as you head east and you start to get into some of those nice areas, it's wonderful. We've done it a couple times myself, my wife and I, and love it.
Yeah, I wasn't all the way into the upper right corner, but I was towards the upper right corner of the U.S. and we were talking to some people from that area, and they were talking about seasons. I said, well, here in San Diego, we have seasons. We have wetsuit season and non-wetsuit season for the ocean.
That's about it. That is about it. I mean, I have worn shorts on Christmas every year for the last 30 plus years. It's a tradition that I'm not going to give up on. So, although it was cold this week. You got into the, low 40s, which is odd for us. Anyway, it's nice to have you back here, and glad you're back all safe and sound. You've went through quarantine for like a week. Because you flew back.
Yes. Yeah. Because I flew, and so I stayed out of public for 7-8 days.
Well, who knows? Maybe sometime later on this year, we'll actually be back in the same studio as.
I drove one way, flew the other.
Yeah. Well, hey, you know what? However you got to do it, you had to get back to do this. You were so excited. You wanted to get back and talk about our topic today, which has to do with this is an article that you and I have both seen by a couple of pretty smart guys, Michael Finke and David Blanchett, a couple of well-known financial big names, financial advisors and planners, and they'd written an article about what to do about the high cost of investment income. Now, it seems strange and it's a weird title, but really what they're talking about in this article is the ability to, when you retire, to squeeze an income out of your portfolio. Do you want to explain in a most basic sense, Professor Plum, what they're talking about when they say the cost of investment income?
Well, it has to do with how much capital do you have to commit to being able to raise a certain amount of cash flow on an annual basis. Historically, to get $1,000 a year of annual income, assuming you wanted to use a balanced portfolio approach, 50-50 stock bond mix, historically you had to have about $25,000 invested to be able to draw $1,000 a year out. You can multiply that by however many thousands you need a year to make that work. But today, to get $1,000 of cash flow out of a portfolio, a 50-50 portfolio, you have to basically commit almost $80,000 to be able to get that same $1,000 that 25,000 used to generate. So when they talk about the high cost, it's how much of a portfolio do we have to be able to create the same income that we used to get 15, 20, 30 years ago, or historically speaking. They basically looked back from 1870 all the way up until 2020 and said, historically speaking, you needed about 25,000. Now, $25,000 creating $1,000 of annual income is right around a 4% distribution, 4% cash flow. That's different than the 4% rule, but it's a 4% cash flow coming from interest payments and or dividends payments.
So
we're coming from not selling anything.
Yeah. So we're it's kind of like how much juice can you squeeze out of it? In other words, if I need a glass of orange juice, I got to have an orange has to be a certain size. Well, nowadays, right, what you're saying is the orange has to be a lot bigger because the amount of juice inside the oranges isn't nearly what it used to be. Why is that? Is it because of low interest rates? What's going on? Why do you need such a bigger portfolio to get the same amount of money out of it?
Well, it's a combination, starting with low interest rates. Historically, we are in an exceptionally low interest rate environment, although higher than we were earlier last year. We're sitting at about 1% on a 10-year treasury, just over that. Historically, they've been closer to the 4% range. And the other side of it is, where else do you get cash flow from an investment portfolio? You get it from dividends. The dividend rate, the average dividend rate, is low today compared to historically. So where we used to be able to generate cash flow from interest and dividends, right now they're sitting at the 2%, 1% to 2% range for cash flow from interest and dividends. It's just, there isn't a lot of cash flow. Now, we've had some very good positive capital gain returns, appreciation returns, which helps to some degree, but that requires sales and other things and managing a portfolio differently. But if all you're trying to do is live off the income that is generated from a portfolio, if you wanted to have it all come from a bond portfolio, you've got to have probably 100,000 or more to get that 1,000, unless you wanted to go to a more risky environment. But from a balanced portfolio, you're looking at like 80 grand to be able to draw that same $1,000 out. That's the high cost. It takes a much larger portfolio because we have historically low dividend and low interest rates. In the past, when we've had low dividend, we had higher interest. In the past, when we had low interest, we had higher dividend rates. They kind of counterbalanced each other. But now we have a situation where both of them are fairly low.
Unusual, is that right?
It seems to be. I mean, everything in the market is unusual the first time you see it, and then all of a sudden it becomes more usual.
They say here in this article, the average bond yield over that period, 1870 to 2010 or 20, maybe it was 20, was about 4.5%. The average dividend yield at 4.1%. Now in 2020, the average bond yield is 0.9% and the average dividend yield 1.6%. So it really is low. And one of the surveys they found on this, and you can comment on this, is that retirees are a behavioral bunch, is what they wrote. Only 22% of
Yes.
retirees plan to spend down their financial assets, 22%. 32% plan on maintaining their financial assets and withdraw only earnings, which I think is where this comes from. And 22% plan on growing their wealth. Now, they say it's not realistic. And I mean, I, as a casual observer, not an advisor, but I would tend to agree with that just looking at it on the face. What do you think?
Well, that's true. That's the way people look at it. So part of the problem with this high cost of investing is, in today's world, we have to be a little bit more creative on how we go about creating cash flow for retirement, how we go about developing a portfolio that we can rely on that takes advantage of what the markets actually are giving us right now, and kind of sets aside the things that they're not giving us right now. And that has a lot to do with how you go about creating your overall retirement income strategy. You can't just sit back and say, you go back to what, the early 80s, when a 30-year treasury was paying 12, 14, 15% or something of that nature, and say, I have $100,000. I want $1,000 a month. I'm going to get that for the next 30 years by just having these bonds guaranteed by the government, because I could put in $100,000 and get $12,000 a year, $1,000 a month, piece of cake, right? That's what was available back then, even though we had some inflation. We don't have that now. So how you go about creating, we have to have a little bit of a mindset change. You can't do the same things that your parents and grandparents did. You can't just sit back on what used to be utility stocks that paid high dividends and things of that nature and live off the income only. It just doesn't exist in today's world. So you have to look at what's the best way to create a portfolio.
So what we're talking about is not touching the principle of any of this.
Right.
What they're referring to is whatever it can kick off without touching principle. Is that correct?
Right. That's what they're talking about. They're saying, put it, set it and forget it. Pay all cash flow that's being generated, not from sales, but from interest and dividends. Pay that out to you each month, each year, and live off that cash flow only. Don't do any sales to create income. You only do that from a buying and selling, picking good and selling bad type area.
Right.
You stay invested in that 50-50 mix or very close to that. Some people will go as high as 60-70% stocks with less in bonds. Some people will go the other way, but still a form of a balanced portfolio. And there are several problems with that in that, first off, it doesn't account for any inflation, which right now we don't have a whole lot of it, but it has a little bit from year to year. The other thing is it just doesn't create enough income. I mean, if you have the S&P 500, the average yield on an S&P 500 index right now is about 1.5%. So if you're looking at just living off the yield, you put in $100,000, you get $1,600 a year in interest on $100,000. You put $100,000 in bonds, 10-year Treasury bonds, you get $1,000 a year in those treasuries. So how do you go about creating a realistic cash flow?
Well, are people turning to things like higher yield or junk corporate bonds and things like that? I mean, I understand.
Well, they're reaching for yield wherever they can find it,
which can be dangerous.
They're saying, I'm going to go find that junk bond fund that's paying 4 or 5%, and they don't bother to look at the risk that's associated with it. They're looking at other areas that may have dramatic illiquidity or higher fees. They're trying to find it, and in every case, they may be able to find the income, but it also comes with a significant amount of risk. And so there is no free lunch. You want higher income, you're going to get higher cash flow, you're going to have higher risk associated with it. And in the long run, not a year-to-year basis, but over 5, 10, 15 years, in many cases, that's going to hurt because the portfolios do go up and down. And unfortunately, the same people that are looking at income only also look at the value of the portfolio. And we have big swings, they get afraid. If your portfolio was $100,000 and we saw a market downturn like what we saw last March, and it turned into $65,000, people get afraid that they're going to lose all their money, even though the cash flow may not have changed. They still freak out and sell, and that's a problem. And that's where people, the emotional aspect, and there's some other sides of it too. The dividend that comes off of stocks is better off used to reinvest in the stocks than it is to pay in cash, especially when it's only 2% right now, 1.5%, 2%.
Wow.
Because you get to buy when it's low and buy when it's high. It's a form of dollar cost averaging, but you get a decent amount of your overall long-term rate of return from that reinvested dividend. Now, if you spend that dividend, you're not getting that extra return.
Now, I could hear somebody saying, "But gee whiz, if I don't spend it, now I'm missing out on income. Now I've really got a problem, Professor Plum, because if I'm reinvesting dividends, there's 2% or whatever that I'm not going to have for income. I'm going to be starving for income here." I know that you're all about solutions, and we've talked about this many times on this show. And there are strategies that we use or you use as an advisor. Let's talk about a way to potentially deal with this high cost of investment income. What is a better way, perhaps, to do this?
Well, let's use investments for what they're good for. Stock market investments for long-term overall rates of return. So let's invest stocks for overall rate of return, which requires reinvesting the dividend. But to do that, we have to have enough money on the sidelines, even in cash or very low-yielding areas, to provide that income. We're going to change the terminology. Income is that cash distribution. I mean, if all I'm earning is 0.9% on a bond fund, why not just put some money in a bank account that's earning maybe a little less than that, not have illiquidity if I need to sell anything, and live off of cash for a few years and let everything else grow. Let it go through its ups and downs. time segment your portfolio. Bucketize your portfolio. Let the stocks do what they do. Let the balanced portfolios do what they do over appropriate time horizons and live off of distributions of cash. Now, what we have found over the years are that, yes, we're breaking one of those emotional rules of not spending principal. But principal is a relative term. If I start with a portfolio of $100,000 and I spend money out of part of it and let the rest of it potentially grow 10 years later, if I still have $100,000 or more dollars, did I actually spend principal? Technically, I did, because I didn't live on cash flow alone. But in the scheme of things, at least I have a much better chance of having $100,000 and still having a 4 or 5% distribution than I would if I tried to just live on cash flow alone. So it's a little bit of a mindset. It's a little bit of a semantic issue. If I have a $100,000 portfolio and I need it to provide $4,000 a year, 4%, 3%, 5%, what number you need, doing it from pure cash flow is almost impossible to do right now unless you're willing to live on less than 2%. And so to do it, a more efficient way, segment it. I mean, you're not getting paid that much for the bonds anyway.
Well, and this is where it gets to people, and this is why I brought this up. This whatever survey they used in this article by Mr. Blanchett and Finke, where he said only 22% of retirees plan to spend down their financial assets. That tells me that 78% don't want to touch their principal. But the real bell goes off, I think, for people when you tell them, yes, if you're going to live off of this cash, as you just said, Professor Plum, you're going to be spending down the principal as well. I mean, how much earnings is there on cash? Is virtually none anyway, as you said.
Virtually nothing.
Yeah, so this is what you live off of. And I think this is the type of strategy that people, for the most part, don't consider until it's explained to them, because it requires them, that 78%, to start thinking about spending down principal, right?
Well, what does spending down principal mean? Does it mean the pure definition of I spent $1? Or does it mean that my portfolio starts at X and it ends at X?
Yeah.
And I didn't, that's it's a different mindset. But
exactly.
You're saying if I have $100,000 and it's only earning that 2% or something, and I want $4,000 a year out of it, 4%, I have to spend some money. To get that money, I have to sell something. And in a positive market, that's not a problem. I can sell something at a gain. But we don't always have positive markets. And we go through. We had a downturn in 2018 that most people have already forgotten about, but it was down almost 20% towards the last half. I think that hit the bottom the day before Christmas in 2018. Mm-hmm. If you were selling assets at that point, you were losing money. We had a fairly dramatic downturn early last year, March, April last year. If you were selling assets to create that extra cash flow over and above the interest and dividends, your portfolio is getting hit hard and it doesn't recover very well. You have to be able to avoid spending assets, avoid selling assets when the markets are down, and if possible, buy when the markets are down. Dollar cost averaging through the dividends and things of that nature makes a lot of sense.
Now, what are you giving up when you set up a portfolio like this? I mean, it seems great, but there must be something that you're giving up in order to get this income.
You're giving up potential return if the market goes straight up. If the market just goes up and 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 doesn't have any bad times, you're giving up that potential return. You're giving up pure, I don't want to say ignorance, pure ease, where you just set it and forget it and you don't even think about it until 15, 20 years from now and then hope that you still have your money there. You actually have to monitor it from time to time. There's a little bit of work that has to be done. So it's not quite as easy. You do have to spend a little time, and I'm not talking about a little bit of time every day. I'm talking about a little bit of time every year, maybe a couple hours a year looking at what's going on, but that's it. But with a 50-50 portfolio, you just send it off and you don't even worry about it. But you also don't get the returns that you potentially could. So in the super positive times, you don't do as well.
But of course, we don't have super positive times, and there's no guarantee that we're going to have them for any length of time at all.
Right, but we have to emotionally get over the fact that while if we were, basically 100% invested, even if it's a 50-50 portfolio, it's 100% invested in something, that when the markets go up and up and up and up, we may not make as much. But when the markets go down and when they have volatility, and markets do get volatile from time to time. I'm not talking day to day. I'm talking over weeks, months, and even years from time to time. That's when having enough money on the sidelines to spend on what you need can do a lot of good. It gives those other assets that went down in value time to recover, so you don't have to sell something when it's down.
Well, and I've read many different surveys that indicate, for the most part, retirees would prefer to lose less than to make more. The pain of losing is a lot worse than the thrill of winning, and I can
right.
I can see that. I can sympathize with that. This is the buckets type strategy that you've been working with people for years and years and talking about this.
Yes.
I've heard different criticisms of it from time to time, but usually when I hear that, it's because they're getting the bucket strategy wrong, which is why I asked you about.
I've heard people doing bucket strategy where they only have 1 or 2 years in cash or safe money, and then the rest is invested.
Yeah. How long do you like to see?
Not enough time.
How long do you like to see?
I'd rather have 5 to 7 years of safe money, because with the average bear market, notwithstanding the last one that was a very short, sharp V, with the average bear, it takes about a year and a half to get to the bottom. If I have a year or 2 years of cash, all that does is get me to the bottom. Then I have to start selling other assets to be able to replenish my cash flow at one of the worst times. It usually takes 4, 5, 6 years just to get back to even. Now, so you've got to take we've had some different times. It doesn't mean the life changes. It means we have to protect ourselves against those negative years. And they're going to happen from time to time. It's just life in the big city nowadays.
Yeah, it's not an assurance that it will always go up or always go down, but historically we've seen ups and downs, and it's best to be prepared for whatever might happen. Bucket strategy, you talk about it a lot. We talk about it a lot. It's kind of what we're all about here. And if you want to learn more about this kind of thing, you can speak with our Professor Rick Plum off the air, 800-644-1150, 800-644-1150. Any of the Lucia Capital Group advisors, they're there to help you out. We're here to help you out. We're here to inform you, entertain you, we hope, on this particular podcast. But it should get you thinking about things that you may not have thought about from a financial perspective. So if you want to learn more about these things, about how buckets works and some of the details involved, once again, you can get in touch with us, 800-644-1150 at Lucia Capital Group. Or, of course, you can go online, luciacap.com, LUCIACAP.com. Hey, we're all out of time for this week. My many thanks to Professor Rick Plum, certified financial planner professional, and my thanks to you folks as well for listening to this particular podcast. It's all about managing your financial future, and that's what we do here. It's what Professor Plum does for a living. We will talk to you again next time. For Professor Rick Plum, I'm Johnny Dean, podcast host. Thanks so much for listening. This is Managing Your Financial Future.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy, including the investments purchased and or investment strategies devised by LCG, will either be suitable or profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the presentation or any component thereof serves as the receipt of or a substitute for personalized advice from LCG or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. These materials are provided for general information and educational purposes based upon public publicly available information from sources believed to be reliable. We cannot assure the accuracy or completeness of these materials. The information in these materials may change at any time and without notice. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. It is important to keep in mind that investments in fixed income products are subject to liquidity or market risk, interest rate risk. Bonds ordinarily decline in price when interest rates rise and rise in price when interest rates fall. Financial or credit risk, inflation or purchasing power risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government but are subject to inflation risk. S&P 500 Index is an unmanaged index and includes a representative sample of large-cap U.S. companies in leading industries. An investment may not be made directly in an index. A dollar cost averaging strategy does not guarantee a profit or protection from loss. Since such an investment plan involves continual investment in securities regardless of fluctuating price levels, you must consider your willingness to continue purchasing during periods of high or low price levels. Bond funds, also referred to as debt funds, invest primarily in bonds, government, corporate, municipal, and convertible, and other debt instruments like mortgage-backed securities, MBS, with the primary goal of generating monthly income for investors. Due to the inverse relationship between interest rates and bond prices, a long-term bond has greater interest rate risk than a short-term bond. Before investing, carefully consider a bond fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial. Michael Finke and David Blanchett are not affiliated with Lucia Capital Group or LPL Financial.